August job growth missed expectations, and while it's not all bad news because unemployment also dropped, we should still talk about it. August payroll grew by less than expected 142,000, but unemployment rate ticked down to 4.2%. The US economy created slightly fewer jobs than expected in August, reflecting a slowing labor market while also clearing the way for the Federal Reserve to lower interest rates this month. Non-farm payrolls expanded by 142,000 during the month, up from 89,000 in July and below the 161,000 consensus forecast from Dow Jones, according to a report on Friday from the Labor Department's Bureau of Labor Statistics. And as you can see here, this is the number of jobs created per month, and these are the updated numbers based on the correction that was issued earlier last month in August. And as you can see, it has been slowing down these past few months. And usually when we get any kind of a headline or a report saying that expectations were missed, the markets react badly to that. And this today is actually kind of inconsistent. Stocks opened flat after jobs report. S&P 500 heads for worst week since April, live updates. And even though it is heading for the worst week since April, that's not super concerning because they opened up flat. Usually they open up and the stocks drop immediately. And as you can see here are some details. Stocks were little changed Friday as investors assessed weaker than expected jobs report and its implication on US monetary policy. The S&P 500 traded just 0.1% higher with the NASDAQ composite. The Dow Jones Industrial Average rose 46 points or 0.1%. And we can look at this over a longer term. In the last day, it is still up today, but in the last 5 days, we can see that while there's a little bit of down, when we look at the last month, we're up 5%. The last 6 months, we're up 8%. The year to date, we're up almost 14%. In the last year, we're up 21%. In the last 5 years, we're up 81%. And if we just look at the total amount of time that the S&P 500 had existed, it is up 600%. This report that we're seeing about the jobs coming in below expectations is important, but it's also important to remember that in a larger context, the stock market and the economy are continuing to improve, with the most important numbers here being coming out of 2020. We're still up close to 90, almost 100%. If you had put money in right at the dip of the pandemic, your money would have basically doubled in that time. Now, adjacent to this news, we have two other reports: the unemployment report, which is pretty good, and the jobs report, which is not quite so good. But first, let's talk about unemployment. As you can see here, meanwhile, the unemployment rate fell to 4.2% from 4.3% in July. August job additions came in higher than the revised 89,000 added in July. Additionally, revisions to the June and July labor reports showed the U.S. economy added 86,000 fewer jobs than initially reported in those months. Wage growth, an important measure for gauging inflation pressures, rose to 3.8% year over year, up from 3.6% annual gain in July. On a monthly basis, wages increased 0.4% higher than the 0.2% seen in the month prior. Also in Friday's report, the labor force participation sat flat from the month prior at 62.7%. So unemployment went down, which is good. Wage growth went up, not by much, but it did go up, and that is also good. And labor force participation is flat, which is actually fine because it's basically the highest it has been since April of 2020, where it sat at 60.1%. Right now at 62.7%, that's a pretty good recovery we've been seeing recently. So there's the good news. And like I've said in the past, there's usually never just good news or just bad news, kind of no matter what. And in this instance, that was the good news. And the bad news is that job openings are falling pretty substantially. Job openings fell more than expected in July, in another sign of labor market softening. And we're going to read a bit here because this is important. Job openings slumped to their lowest level in 3.5 years in July, the Labor Department reported Wednesday, in another sign of a slack labor market. The department's closely watched job openings and labor turnover survey, which is the JOLTS, showed that available positions fell to 7.67 million on the month, off 237,000 from June's downwardly revised number and to the lowest level since January of 2021. Economists surveyed by the Dow Jones had been looking for about 8.1 million jobs. With a decline, it brought the ratio of job openings per available worker down to less than 1.1, about half of where it was from its peak of more than 2 to 1 in early 2022. The data likely provides further ammunition to the Federal Reserve officials who are widely expected to begin lowering rates when they meet for their next policy meeting on September 17th and 18th. Federal officials watch the JOLTS Act report closely as an indicator of labor market strength. Last paragraph. The labor market is no longer cooling down to its pre-pandemic temperature. It's dropping past it, said Nick Bunker, head of the economic research at Indeed Hiring Lab. No one, and certainly not policymakers at the Federal Reserve, should want the labor market to get any cooler than this at this point. And I read a quote that I think puts this quite nicely. I don't like this a whole lot. It's not a disaster, but it's below expectations on the headline. And what really bothers me is the revision, said Dan North, senior economist for North America Aliens Trade. This is certainly going the wrong way. Now, even with the bad news of the job openings dropping and also coming in lower than expectations, the good news for that is that it does create a pretty strong case for the Fed to cut rates in September by as little as 0.25%, but also possibly as much as 0.5% because of the reports and the readings we've been getting over the last couple of months. But to see how much they do, or if they do at all, we'll just have to wait and see. Thanks for watching.